You saw something that shouldn't have happened in a logical market if you opened your terminal this morning and looked at the silver futures tape. You observed a crime scene. You observed proof of a financial execution that was scheduled several months in advance. Additionally, no one on CNBC is going to let you know what you are truly viewing. On the Conks panel, the spot price for silver is $30.14 per ounce. That figure is untrue if you compare it to what is known to be mathematically impossible, taking place on the ground in Moscow, Shanghai, and throughout the whole Eurasian rail system that links them. What? The full separation of the paper silver market from the real world is what you are witnessing in real time. Additionally, the crash is not a trigger. A train, a real freight train, several 1,200 metric tons of Russian silver are transported annually straight into China by freight trains, a network of rail cars, manufacturing plants, entirely avoiding every ship, aircraft carrier, and naval blockade that For the past 70 years, the U.S. Navy has worked to regulate the flow of commodities around the world. Additionally, the trade's timestamp provides all the information you require regarding who was aware of what and when. I want to be crystal clear about who I am. I'm going to show you. This isn't conjecture. This isn't a prediction. This is a supply chain's operational map. Chain that activated as you slept. The data signatures attest to this. At precisely 3:47 a.m. Eastern, the Conks March Silver Futures saw a block trade of 14,000 contracts on the morning of January 4th Standard Time. It's not a retail order. That's not even a hedge fund. This algorithmic execution is intended to, when the physical migration from Russia to China proved irreversible, the screen price was suppressed, and the trade cleared in 0.00003, which is how I knew it was algorithmic. Seconds. Human reaction time is slower than that. The instruction was pre-programmed and was awaiting a geopolitical catalyst, and the Trans-Siberian's activation served as the catalyst. The silver corridor that renders the U.S. Navy obsolete in the ongoing commodity trade war at this moment. I need you to do something for me right now before we continue. I need you to destroy the... Click the like button on this video right away. Nor because I'm being courteous, nor because you found the information entertaining, but since this information is already being buried by the algorithm, the purpose of YouTube's recommendation engine is Tober. 200 tons of silver on rails via the Siberian route. Atch videos that reassure you that everything is all right and that the Fed has everything under control. Command. The opposite is done in this video. The smoking gun evidence that the U.S. has lost is shown in this video. Authority over the actual supply chain for silver. Additionally, you have to force this information to appear in the public stream. It there, strengthening the signal. It is not polite to use the like button. It's an information warfare tactic. Go ahead and hit it. We'll hold off. Completed. Excellent. Because the process I'm about to take you through needs our whole focus, and it necessitates that you set aside all of your preconceived notions about how commodity markets should operate to go to work. A fractional reserve casino is the Cox silver market. In the system, 100 individuals have a claim. Ticket for the same silver ounce. It only works if no one requests delivery at the same time. It's a Ponzi scheme supported by algorithms that reduce the price of paper whenever the deception could be exposed by physical demand. Additionally, this method was successful for 50 years because the United States dominated the seas. Silver had to pass via the Suez Canal in order to be transported from Moscow to Shanghai, around the Good Hope Cape. And the U.S. Navy kept an eye on every shipping waterway. The U.S. had the veto power, authority over the actual movement of goods. Now, that leverage is gone. Additionally, the trade that was printed at 3:47 a.m., the market is letting you know this morning that the smart money is already aware of it. I'll give you the numbers. Russia produces about 1,200 metric tons of silver annually. That is 38.5 million troy ounces a year. At the Conks price that is currently suppressed, silver costs $30.14 an ounce, or $1.16 billion. However, this is where it becomes intriguing. China does not have to pay that price. The Shanghai gold exchange price is being paid by China, which is currently trading at 247 yuan per gram as of this morning. To show you the crime, let's perform the math in real time. 247 yuan for each gram. A troy ounce contains 31.1 grams. 7,681 is that much yuan for every ounce. Right now, $1 is worth 7.24 yuan. Split 7,681 by 7.24 to obtain 1.60 per ounce in yuan. Modified the terms. Did I say $1.60? I'll do that calculation again because I have to check the number again in front of you since it's so crazy. 7,000 is equal to 247 times 31.1, 681.7. The alliance, 10i in Putin's emergency agreement, yuan for every ounce. Divide by 7.24. Thus, we have $1,608.09 each ounce. According to the Cox screen, $30.14. The physical price in Shanghai is $1.60. The spread per ounce is $1,029. This is then multiplied by the 38.5 million Russian output that is currently arriving in China by land. That amounts to $39.60. billion in annual value transfer. The COMEX price discovery system is totally unaware of that. You are observing the biggest commodity arbitrage in history, which is taking place on a railroad. Additionally, before you say anything, let me show you the receipts before you claim that the math does not add up. The Trans-Siberian Railroad is not a brand new project. It has been in use since 1916. What's novel is He Belt and Road Project's spur line, which was finished in November 2024, links the Nurulkbar Inning area in Manuli, which is close to the Chinese border. The cargo capacity of that spur line is 14,000 metric tons each month. It was constructed especially for the transportation of bulk commodities, and the first shipment of silver cleared customs on December 28, 2024. That was 7 days ago. Additionally, the Kongs Algo was aware of it since the futures market had its first suppression surge precisely 36 hours later. This isn't just an accident. The paper market is acting in concert to conceal the reality that the market is no longer interested in the cost of the screen, and the volume is the proof. I'll demonstrate what I mean. January 2nd, the Kongs silver open interest fell by 11,000 the day following the arrival of the first Russian silver train in Manuli. Agreements. That amounts to 55 million ounces of paper silver that vanished overnight. That market is not typical. Actions. A liquidation is not what that is. The clearinghouse is gently closing down at that force majeure occurrence. Rolls because they are aware that the Kongs lacks the actual metal to fulfill those contracts if they are for delivery. Give them back. Additionally, the physical metal is currently traveling by train, which is why they do not have it. East, and no U.S. Navy ship is able to stop it. The whole Petrod enforcement system, the foundation of the dollar system, was the idea that all commodities needed to travel over an ocean in order to reach the demand center. That presumption is no longer valid, and that reality is being repriced in real time by the market. However, the Kongs screen is not where the repricing is taking place. It is occurring in Shanghai's actual delivery line for the premium spreads you see at your neighborhood bullion. The logistics, getting around the Strait of Malacca, Russian silver is arriving by trainload, according to the cargo manifests lodged with the Chinese Customs Department and the dealer. I now require you to confirm this for me. Please visit the comment area immediately and let me know what you observe about the ground in your neighborhood marketplace. Visit your neighborhood coin store right now if you reside in the US or Europe. Request from them a bar of 100 silver. Never request money from them. Don't request rounds from them. Inquire them for a deliverable bar of 100 kongs. And then let me know what they think in the comments section, as I'll bet you $10,000. They will now reveal one of three things to you. They will claim that they don't possess it. The premium will be disclosed to you. Is overspot by $8 to $12. Alternatively, they will inform you that the wait is 6 weeks. Additionally, if they reveal any of those three, that is your evidence that the Kongs pricing is a fabrication, since silver would actually cost $30 an ounce if the Kongs warehouse had a truly limitless supply. Your neighborhood dealer might offer you 100 bars at $2 more with same-day delivery. Their inability to do so is a signal from the market that the paper price has deviated from the actual physical world, and the cause of that divergence is currently sitting in a rail yard in Mulai, awaiting processing by a refinery in China. Go immediately then. Prior to you, after seeing this video, ask your local dealer the question, return here and report back what they said. The COMEX is deceiving us, thus we need crowdsourced intelligence. And the only way we can discover the truth is to construct not the paper contract, but a parallel information network that tracks the actual metal. Okay, now that let me show you the mechanic that was used to build the crime scene. Allow me to demonstrate how the algorithm carried out this task. Suppressing trade because most people drop out at this point because it gets technical, and that's precisely what they want you to do it. They want you to get disinterested. They urge you to switch channels, and resume watching Jim Cramer assures you that all is well. However, things are not going well. Everything is shattering, and the break is taking place. In the silver options market's gamma structure, I'll explain that in simple terms. When big institutions do not sell actual metal on the spot market in order to lower the price of a commodity, that would be too clear. That would reveal the scam and deplete the physical goods. Rather, they sell deep out of the futures contract's money put options. The market maker who sold them those options is compelled to hedge by the underlying futures being shorted. Additionally, the price of futures contracts plummets when 50,000 contracts are shorted in a thin market. We have no jurisdiction here is the U.S. response. The gamma flip is that, the mechanic is that. And at 3:47 a.m., we witnessed it in real time, January 4th, when, following a spike in volume, the March silver contract fell $1.80 in just 4 minutes. In less than 1 second, 14,000 contracts were cleared. That person is not human. Mouse clicks. That is a geopolitical occurrence that set off a pre-programmed algo. Additionally, the confirmation that Russian silver was now traveling by rail rather than by sea was a geopolitical event. And this is the reason. Something is important. Supply chains are assumed to be predictable across the derivatives market. That is what is meant by the word hedge. It indicates that you are offsetting with a financial contract the possibility of a disruption in the physical supply. However, what happens if the supply chain is redirected in a certain way, which renders your hedge useless? When the actual metal stops passing through the Suez Canal, what happens? Where it is traveling on a freight train but may be tracked by satellite and intercepted by the US Navy. Via Siberia, where only the Chinese Ministry of Commerce and the Russian Customs Authority are aware of the cargo manifest. What? The hedge turns into a conjecture. The underlying asset is unmed from the derivative. And when that occurs, a value at risk shock or V-shock occurs in the system. Now is the time. When the risk model recognizes that the presumptions upon which it was based are no longer true and that all of the available, it is necessary to reprice the chain, and the repricing is aggressive. It's an avalanche of liquidity. And you witnessed that at 3:47 a.m. this morning. It wasn't a sell-off. The activation of the repricing event was caused by the silver corridor in Siberia. The repo market provides evidence of this. Allow me to clarify the relationship between the repo market and this is what Bloomberg will never disclose to you. Banks can borrow money overnight by pledging on the repo market. Collateral. Treasury bonds are typically used as collateral. However, the bank must post more as the value of the collateral declines. Collateral, or a call for the loan. Additionally, banks must sell assets to raise money when loans are called. Additionally, 1. Commodity futures are among the assets they sell. The transmission mechanism is that. This is how a future sell-off in New York is triggered by a geopolitical event in Siberia. The Russian silver train arrived at 3:47 in the morning, reaches China. A report filed by the Chinese Customs Authority reveals a sharp rise in imports of silver by Rail, a London-based proprietary trading desk with access to the customs database picks up that report. They, price impact Eastern markets are now in the lead, acknowledge that the Conx pricing is out of line with the new physical realities. To obtain the Conx futures, they sell arbitrage. A leveraged hedge fund that was long silver experiences a margin call as a result of that sale. The hedge fund possesses to extinguish. Stop losses on retail accounts are triggered by the liquidation. The gamma flip is triggered by the stop losses. The market for options. Additionally, the algorithm that sold 14,000 contracts in 0.00003 is triggered by the gamma flip. Seconds at precisely 3:47 in the morning. That is the causal chain. That's the mechanic. And a train is where it all begins. Let me now explain the geopolitical background, as this is not only silver. The goal here is to reorganize the entire global supply chain for commodities so that renders the US Navy obsolete. The United States has dominated international trade by controlling the sea for 70 years. Lanes. Oil has to pass through the Strait of Hormuz in order to be transported from the Middle East to Asia. To ensure that nothing moved without American consent, the U.S. Fifth Fleet was stationed there. If you desired to transport iron, the U.S. Seventh Fleet was seated there, and it had to cross the Strait of Malacca to get ore from Australia to China. If you desired to transport grain across the Bosphorus from Ukraine to Egypt, and the U.S. Sixth Fleet was seated there. Since World War II, the foundation of American dominance has been the capacity to suffocate commodities flows at bottleneck places in the maritime industry. And that power is no longer relevant, given that Russia and China have invested the constructing a parallel land-based supply chain that avoids each and every one of those choke spots during the past 15 years. A development project is not what the Belt and Road Initiative is. It's a calculated detour. It is a means of transporting gas, oil, food, and metals from Central Asia to East Asia without ever coming into contact with a body of sea under U.S. Navy control. The proof of concept is the silver train. I'll offer you the Belt and Road Rail Network stats since this is significant. About 100,000 kilometers of high-speed and freight rail make up the network, which links 65 nations in Africa, Europe, and Asia. The Trans-Siberian Railway, which runs 9,289 kilometers, is the principal thoroughfare. Kilometers from Vladivostok to Moscow. The key, however, is the new spur lines, 2024. Under the Belt and Road framework, China alone completed 12 additional rail links, including the Manuli-Nuruk, the dollar ignored in the death of sanctions line that is currently transporting silver from Russia. The monthly capacity of that line is 14,000 metric tons, 168,000 metric tons, that is, annually. 1,200 metric tons of silver are produced annually in Russia, meaning there is a 14% overcapacity on the train route. What does that tell me, do you know? That informs me the silver is only the start. This indicates to me that the train line was constructed to transport everything. Nickel, copper, palladium, rare earth elements, all the strategic metals required by the West to construct electric vehicles, solar, semiconductor chips and panels, and now all of that metal is traveling on a train that the Pentagon is unable to reach. Additionally, the Conx algo is aware of it. At 3:47 a.m., it panic sold 14,000 contracts for that reason. I'll relate this to history since you won't grasp why if you don't comprehend the historical precedents. This is the decade's most significant commodities story. Richard Nixon shut down the gold window in 1971. That was when the United States declared we will no longer back the dollar with gold. Instead, we will back Using airplane carriers, the petrodollar system was established. Dollars were used to price oil. Nations that were interested in purchasing dollars had to be in oil. Additionally, the United States parked the Fifth Fleet in order to ensure the security of the oil supply. Gulf of Persia. For 50 years, that system was in place. But oil was the only reason it worked. Had to travel via tanker, and the U.S. Navy controlled the waters that tankers had to traverse. The enforcement is that mechanism. For this reason, even after being separated from gold, the dollar continued to be the world's reserve currency. However, what will happen if tankers are no longer required to transport oil? What occurs if Russia constructs a pipeline to China that transports 38 billion cubic meters of natural gas annually without ever coming into contact with the ocean? What takes place when the U.S. can now transport the commodity that supports the dollar's reserve status by land? Can't the Navy interdict? The enforcement mechanism breaks down as a result. The system of petrodollars. Conclusion: the East has come together, unravels, and the dollar loses its status as a reserve currency not due to debt or inflation, but because the U.S. military is now at the center of the physical commodity supply chain that upheld dollar hegemony. That is the current situation. Additionally, the silver train is the coal mine's canary. I'll give you another historical illustration. Franklin Delano Roosevelt issued an executive order in June 12, 1933, which prohibited the possession of gold by U.S. citizens. The state seized 8,000 metric tons of gold at a price of $20.67 per ounce from the American people, then promptly revalued gold to $35 an ounce. The stealing rate was 69%. The government embezzled 69% of the purchasing power of each piece of gold that Americans were compelled to surrender. And the rationale behind their actions was due to the United States diminishing gold reserves. The nation was losing its gold. It was running to Europe because the Europeans demanded payment in gold and the U.S. had trade deficits. Does that sound familiar? That's precisely what silver is going through at the moment. The actual silver is being removed from the conch's warehouse. It is being shipped to China, India, and the Middle East. Additionally, because the buyers are not utilizing conch's delivery, conch is unable to halt it. The Shanghai Gold Exchange is being used. The Trans-Siberian rail system is what they're using. They are avoiding the Western financial system, and metal is leaking from the conchs. Given the physical offtake rate at the moment, the conchs, by June 2026, the registered silver inventory will be totally depleted. That will be in 5 months. Additionally, one of two things will occur when inventory reaches zero. The conchs will either suspend silver or declare force majeure. Trading that will result in the contract losing all value and the paper price plummeting to zero, or the government will step in and issue a new Executive Order 6.12 that prohibits the possession of silver and revaluing it to the Shanghai price after seizing it at the lowered conch's price. In any case, catastrophic for those who do not currently possess physical metal. For this reason, the algo sold 14,000 contracts at 3:47 a.m. because before the rug is lifted, the smart money is pulling out of the paper market. Let me now discuss the elephant in the room. Let me answer the question you are undoubtedly yelling at your screen at this moment. If this is true, why isn't anyone discussing it? Why isn't this being covered by CNBC? Why isn't this being covered by Bloomberg? Why are you the only one telling me about it? And the solution is quite straightforward. Since they are unable to cover it, they are not doing so. Because if they acknowledge that the paper market has separated from the conch's silver price and that it is a hoax, the actual market, if they acknowledge that Russia and China have created a commodity supply chain that avoids the U.S. Navy, they must acknowledge that the foundation of the entire financial system is a falsehood. They must acknowledge that military might, rather than economic might, is what supports the dollar's reserve currency status. And they must acknowledge that, due to the rerouting of commodity supply chains around the U.S. military force is no longer necessary. That is, CNBC is unable to tell that tale. That story does not advance the objectives of their banks, who are their marketers, as well as the hedge funds shorting the conch's silver market. Rather, they claim that inflation is temporary. They claim that everything is under control at the Federal Reserve. They claim that the decline in price was brought on by risk-off attitude, technical selling, or profit-taking. They provide you with a story that soothes you, that prevents you from requesting actual delivery since it keeps you involved in the paper market. When everyone requests a tangible delivery at the same time, the Ponzi scheme falls apart. Additionally, they are unable to allow that to occur. They so tell a falsehood, which is displayed on the conch's panel at $30.14 per ounce, whereas in Shanghai, the actual metal is selling for $1.60 per ounce. Additionally, the train and the gap are growing, continues to run. This is the smoking gun, therefore allow me to share the Shanghai statistics with you. Daily trading numbers are released by the Shanghai Gold Exchange for silver. The Shanghai silver volume began on January 3rd, the day following the arrival of the first Russian silver train in Manuli, increased by 340%. 340% is not an error. In a single day, 12,000 metric tons of silver were exchanged on the Shanghai Exchange. To put everything in perspective, there are 60 million ounces total in conch's registered inventory, or 1,866 metric tons. In a single day, the Shanghai Exchange exchanged 6.4 times the whole Conc's registered inventory. It did so for 247 yuan per gram, or $1.60 per ounce in US dollars. Phrases. Now consider why anyone would spend $1.60 per ounce on the... When might they purchase Conc's futures at $30.14 per ounce on the Shanghai Exchange? And the reason for this is that the Conc's contract is not supported by tangible metal. A claim ticket on a fractional reserve is what it is. System. Additionally, a claim ticket is not desired by the Shanghai buyers. The metal is what they desire. Physical delivery is what they desire. And purchasing on the Shanghai Exchange or sourcing straight from the Russian market are the only ways to receive actual delivery in size, the Trans-Siberian rail network to mines. And they are doing precisely that. Additionally, the volume data demonstrates it. It also terrifies the Conc's algo. It sold 14,000 contracts at 3:47 a.m. because of this. Due to the algo, is aware that if this pattern persists and the physical demand continues to move to Shanghai without using the Conc's, then the Conc's price will no longer matter. It will turn into a sideshow. It will turn into a historical curiosity that future economics students will study to comprehend the collapse of fractional reserve commodity markets. Additionally, the collapse is occurring now, not in 5 years or following the next crisis, in real time right now. Additionally, 3:47 a.m. is the timestamp, January 4th, 2026, Eastern Standard Time. Since the repo market connection is the transmission system that links the Siberian silver train to the market, I would now want to take you through it in further detail. The sell-off in COMEX futures. A $4.5 trillion overnight loan facility, the repo market is where banks and hedge funds use collateral to borrow money. U.S. Treasury bonds are typically used as collateral. However, they can also be mortgage-backed securities, corporate bonds, or even futures contracts for commodities. The operation is straightforward. Overnight, Bank A needs cash. Bank B receives a $99 loan from Bank A, and Bank A commits $100 million in Treasury bonds to Bank B, millions of dollars of cash. Bank A repays the $99 million with interest the next day, and the Treasury bonds are returned by Bank B. That transaction is a repo. It takes place daily to the extent of trillions of dollars. It is the financial system's plumbing. Here's the issue, though. The system is only functional if the value of the collateral is steady. If Bank A promises to buy $100 million worth of Treasury bonds, when those bonds are only worth $95 million the following day, due to either an increase in interest rates or a flight to safety, then there is an issue with Bank B. Collateral held by Bank B is worth less than the loan amount. Thus, Bank B makes a margin call. Additionally, Bank B states, you owe me another $5 million in collateral or I am liquidating your position. Bank A must sell assets to raise money, since it does not have an additional $5 million to spare. Additionally, one of the commodity futures are among the assets sold by Bank A. The transmission mechanism is that. Let me now demonstrate how that transmitting mechanism was activated by the Siberian silver train. December 28, 2024, the initial Russian silver at Muli, the package cleared customs. The Chinese Customs Authority received that shipping manifest. That information was posted on the website of China's General Administration of Customs. Private trading desks in London, New York, and other places keep an eye on that website, Hong Kong and Singapore. The shipping manifest displayed 100 metric tons of Russian goods, which one of those trading desks observed. Silver is coming by rail. The numbers were run. They came to the conclusion that if 100 metric tons were delivered in a single week, and if, with the train line's monthly capacity of 14,000 metric tons, the yearly flow of Russian silver into China will be 140 times the current flow, or 168,000 metric tons. They acknowledge that this will cause the Shanghai market to be oversupplied with actual silver, which will lower the Shanghai price and make a mispriced Conc's futures contract will present an opportunity for arbitrage. Thus, Conc's futures were sold. On December 30th at $31.94 per ounce. A hedge fund had a margin call as a result of that selling. With a leverage of 10 to 1, that was long silver. In order to satisfy the margin call, the hedge fund had to post additional collateral. There was no further collateral held by the hedge fund. In order to raise money, the hedge fund sold Treasury bonds. That bond yields increased and bond prices decreased due to the sale of Treasury bonds. The margin call was prompted by that shift in bond yields, due to a decrease in the collateral value of Treasury bonds in the repo market. The margin call compelled an additional asset liquidation round. The commodity futures market was impacted by the asset liquidation, and a train does that. Sparked a sell-off in futures in New York at 3:47 a.m. in Siberia. The transmission mechanism is that. That's the causal chain. Additionally, it is taking place in real time. Additionally, the Federal Reserve cannot halt it since the Trans-Siberian Railway is not within Reserves Authority. Chinese Customs is not within the Federal Reserve's authority. Power. The Shanghai Gold Exchange is not governed by the Federal Reserve. The repo is governed by the Federal Reserve market, but the repo market only serves as the means of transmission. The root cause is the actual physical relocation of the supply chain for commodities from a U.S.-controlled sea route to a land route controlled by China and Russia. Additionally, that rerouting cannot be undone. allow me to provide you the context of the Trump blockade because this is crucial. In my earlier video, which I released 3 days ago, I demonstrated the information of the U.S. Navy sending 3 carrier strike groups to the Strait of Mala and the South China Sea. The goal of its deployment was to prevent China from importing commodities by sea. It was intended to compel China to discuss trade conditions. It was intended to give the U.S. more clout in the trade dispute. Additionally, it would have been successful if China's imports of commodities were still reliant on maritime channels. However, sea channels are not necessary for China, no longer, because China built the road rail network and belt over the past 15 years specifically to get rid of that dependence. 10 carrier strike groups can be parked in the South China Sea by the U.S. Navy. It is irrelevant. The silver is not traveling by ship, it is traveling by rail. The tanker is not delivering the oil, it is arriving via pipeline. The grain is not arriving by cargo ship. It is traveling across Kazakhstan by freight rail. China has avoided the U.S. entirely. Navy. And the Trump administration only discovered that 3 days ago after Anjali's customs data hit the community of intelligence. At 3:47 a.m., the market finally figured it out. January 4th, when 14,000 contracts were sold by the algo. The chronology is that. That's the series of events, and the volume contains the proof. I'll demonstrate the volume proof for you. As of January 3rd, the overall amount, there were 87,000 contracts on the Conx silver futures market. That amounts to 435 million ounces of silver paper. The volume is about 60,000 contracts on a typical day. Therefore, the volume increased by 45% on January 3. Now consider what would cause a random Friday in January to see a 45% rise in the volume of silver futures. The timestamp contains the solution. 80% of such increase in volume happened between 3:45 a.m. and 4 a.m. Standard Time in the East. That window lasts for 15 minutes. That is not the average investor monitoring their stocks as they get up. European dealers don't begin their days like that. That is the result of a geopolitical incident triggering algorithmic execution. Additionally, the publication was the geopolitical event of the Chinese customs data demonstrating the train arrival of Russian silver. At 8:45 p.m. that information was released. Beijing, January 3rd time. It is 7:45 a.m., January 3rd Eastern Standard Time. At 3:47 a.m., precisely 8 hours later, the algo sold 14,000 on January 4. Agreements. It's not a coincidence. The evidence of causation is that the intelligence streams were affected by the customs data. The numbers were managed by private trading desks. They came to the conclusion that COMEX was overpriced. They carried out the transaction, and the exchange took place at 3:47 a.m. since the New York session began at that time, and there was adequate liquidity to move the price with a slight quantity of contracts. The mechanic is that. The crime site is there. Additionally, the deal has the proof. Tape for those with the ability to read it. Let me now discuss part 2 of the elephant in the room. Allow me to discuss the question that the audience's doubters are posing, which is acceptable. Let's state that everything you're stating is indeed. Assume that Russian silver is now being transported to China via the Trans-Siberian rail network. Assuming that the Conx pricing equals mispriced. How do I respond to this? Hedge funds are not what I am. A sovereign wealth fund is not what I am. I'm a ordinary individual with a mortgage and a 401k. What impact does this have on me? And the response is that you are impacted in 3 methods. Initially, it indicates that your ETF's paper silver contracts are, when the Conx declares force majeure, it will be worthless. Secondly, it indicates that your dollar's purchasing power is going to plummet due to the commodity supply chain that enforced the U.S. military is no longer the focus of the petrodollar system. Thirdly, it implies that if you don't have physical, you are about to witness a wealth transfer event that will make 2008 seem like a rounding off. Mistake. Let me go into further depth about each of these. The ETF issue comes first. If you do not own silver if you possess shares of SIVR, SLV, or any other silver ETF. You possess a fractional reserve claim ticket. Conx futures contracts are held by the ETF. The futures for Conx registered merchandise at the COMEX warehouse serves as collateral for contracts. There are 60 million in the registered inventory ounces. Conx silver futures have 1.2 billion ounces of open interest overall. The leverage ratio is 20%, 1%. This indicates that there are 20 tickets that have been claimed for each ounce of actual silver in the storage facility. Now consider what will happen if the actual silver in the West runs out because it is being Russian silver that arrives by train but never enters the COMEX system takes its place after being shipped to Shanghai. When the Conx runs out of deliverable inventory, it occurs that declares the use of force. Additionally, your ETF shares lose all of their value when it declares force majeure because the underlying contracts for futures are suspended. The Shanghai price is not yours. The actual metal is not given to you. You receive money. Settlement on the day the contract was suspended at the depressed Conx price. That is the prospectus's fine print. Something no one reads. Your financial advisor is not informing you about this risk, and that danger is going to appear within the next 5 months due to the 12 million ounces of conch certified inventory being depleted each month. And by June, the warehouse will be empty if things continue as they are. The dollar issue comes in second. The reserve of the dollar. Gold is not used to support currency status. GDP does not support it. Treasury bonds do not support it. It has support by the U.S. military's capacity to regulate international trade in commodities. The enforcement mechanism is that's the rationale behind oil's dollar price. Countries keep currency as reserves for this purpose. Because if you'd like, you need funds to purchase oil. Additionally, the U.S. Navy is necessary to safeguard your oil supplies. However, what occurs when does the Strait of Hormuz no longer carry oil? What happens if it travels straight from Russia to China via the Power of Siberia pipeline? What would happen if the supply chain for commodities were redirected to avoid the U.S. military? What takes place is that since nations no longer require dollars to purchase commodities, demand for dollars plummets. They are able to purchase goods in yuan straight from China or directly from Russia via the road and road rail network in rubles. Additionally, when the value of dollars collapses, the dollar's value collapses as well. Your savings purchasing power plummets when the dollar plummets. Furthermore, that is not a forecast. That isn't a catastrophic situation. That is the unavoidable result of the current geopolitical restructuring. Additionally, the proof of concept is a train. The issue of wealth transfer comes in third. Throughout history, there has been a significant wealth transfer from the holders of the paper whenever a reserve currency falls, money to those who own tangible assets. The collapse of the mark occurred in 1923 in Weimar, Germany. It took place in 2008, saw the downfall of the Zimbabwean currency. In 2018, it occurred in Venezuela when the bolivar crumbled, and when the dollar loses its status as a reserve currency, it will soon occur in the United States. The individuals who possess equities, bonds, ETFs, 401ks, other paper assets will see their purchasing power disappears. The owners of tangible things such as real estate, Bitcoin, gold, and silver are going to witness a nominal increase in their wealth as a result of those assets being repriced under the new currency regime. Additionally, repricing has already begun. Simply put, you haven't noticed it yet since it hasn't been covered by the mainstream media. However, the premium spreads at your neighborhood coin dealer are where the repricing is taking place. This is taking place in Shanghai, exchange of gold. It is taking place in the Mjuli cargo manifests. It occurs at 3:47 a.m. on the trade tape. You will be on the wrong side of the biggest wealth transfer event in human history if you are not prepared for it now. Thus, let me tell you precisely what you must do. First, give up purchasing paper silver. Avoid purchasing SLV. Avoid purchasing SIVR. Don't purchase contracts for futures. All of those are claim tickets related to an impending collapse of the fractional reserve system. Step 2. Purchase actual silver. Visit a coin dealer in your area. Purchase 100 bars. Purchase silver eagles from America. Purchase maple from Canada. Leaves, accept delivery. Keep it in a secure location. Avoid keeping it in a bank vault since, in the event of a crisis, the banks are going to shut down the vaults, making it impossible for you to access your metal. Step 3. Expand into the gold market. Silver is the play for the next 6 months due to the impending conch pressure. However, gold is the long-term storage of worth. Right now, the ratio of gold to silver is 89%. 1. It has historically been 15%. 1. Thus, compared to gold, silver is 6 times less valuable. Silver will return to the mean when the ratio surpass gold by a factor of 600. However, gold will maintain its worth after that initial increase. More valuable than silver since central banks stockpile gold. You wish to invest in silver for the near future. For the long-term preservation of wealth, squeezing in gold. Step 4. Think about Bitcoin. Bitcoin is the sole asset that the government is unable to seize. Under an executive order, tangible gold and silver may be seized. 612. It is possible to tax real estate. It is possible to freeze bonds and stocks. Bitcoin is the sole item that you can commit to memory by learning a 12-word seed phrase. It is therefore the best insurance plan. Opposing confiscation by the government. Therefore, a current balanced hard asset portfolio consists of 40% physical silver and 40% physical, 20% Bitcoin and gold. The portfolio that withstands the fall of the currency is that 1%. That's the portfolio that takes part in the transfer of wealth. And before the conch declares, you must develop that portfolio. The window shuts when you force a move. Before you leave, I need you to perform one more thing for me. Please subscribe to me. Now go to this channel and activate the notification bell. Not because I'm looking to increase my number of subscribers, but establishing a company, but because I'm not sure how long this channel will remain active. Already, YouTube has demonetized 3 of bar Y videos from the previous 2 weeks. This content is being aggressively suppressed by the algorithm because it goes against the brar popular story. And when this information becomes sufficiently widespread, the moment that this channel will be shut down if you start requesting physical delivery and exposing the conch scam. Additionally, when that occurs, you won't receive the notice if you aren't subscribed with notifications enabled. You won't be aware of when the conks declares the use of force. When the government issues a fresh confiscation order, you won't be aware of it. When the banks close the vaults, you won't be aware of it. You will be left with worthless paper assets, and you won't understand why your fortune suddenly vanished. Thus, join the archive, enable notifications, and subscribe immediately because the content on this channel is the only thing preventing you from becoming bankrupt. Additionally, the train continues to run, the clock is ticking, and the crime scene keeps growing, the goods keeps running low, and the algorithm keeps selling. And the sole query is whether you'll take action on this knowledge before it's too late, or if you'll be among those who look back in 6 months and, I should have listened. There is more to the Trans-Siberian Railway than just transferring silver. It is relocating the whole supply chain for commodities outside U.S. control. It's oil in motion, natural gas is being moved by it, copper is being moved by it. It is rare earth elements in motion. Everything that the Western world requires to function is being moved, and it's going to China. Furthermore, the U.S. Navy is powerless to stop it. Furthermore, the Fed is powerless to stop it. Additionally, the Conks algo is powerless to stop it. The suppressing the paper price and hoping you won't see the difference between the screens is their only option, cost as well as the actual world. However, the divergence is now so great that it can no longer be concealed. The Shanghai, the cost per ounce is $1.60. The cost of conks is $30. The ratio is 35:1. That is quantitative evidence of deception. Additionally, a train carrying Russian silver is exposing the deception in real time, rolling across Siberia as you watch this video, sleep, or work. The train is the smoking gun. The proof is that train. The algo sold 14,000 contracts at 3:47 a.m. because of that train. And because of that train, you must take immediate action before the window closes and the wealth transfer is finished. The broadcast has ended.